Understanding Elliot Waves. There are many tools and tactics available to forecast market moves. The Elliot Wave Theory is one of the most intriguing and popular approaches. This theory was developed to shed light on the psychology of market players and the underlying rhythm of market pricing. This video aims to simplify this complicated theory into 5 easily understood points, giving you a better idea of how trading and investing can use it. 1. The foundation of Elliot Wave Theory. The Elliot Wave Theory is the notion that investor behavior as a whole causes market prices to change in predictable ways. In the 1930s, Ralph Nelson Elliott noticed these trends after examining 75 years' worth of stock market data. He reasoned that investor psychology and their responses to outside events drove the recurring cycles in market values, which he dubbed waves. Elliott distinguished between 2 kinds of waves: corrective waves, which go against the main trend, and impulsive waves, which travel in the direction of the main trend. These waves create a fractal pattern where smaller waves fit within larger waves, forming the fundamental units of the market's price movement. 2. The basic structure: impulse and corrective waves. Elliot Wave Theory is based on 2 primary wave types: impulse and corrective. There are 5 impulse waves that are the driving force behind a market movement. The first, third, and fifth waves follow the trend. The second and fourth waves represent minor retracements or corrections. For example, in a bull market, waves 1, 3, and 5 would rise higher, while waves 2 and 4 would go lower. The third wave is usually the longest and strongest. The market usually goes against the trend during a corrective wave that follows an impulse wave. The 3 waves that make up a corrective wave are A, B, and C. Wave A descends. Wave B rises as a partial rebound, and Wave C descends once more to finish the correction in a bull market. Knowing these 2 waveforms helps traders to recognize market trend stages and possible turning points. 3. The fractal nature of Elliot waves. The fractal nature of Elliot Wave Theory indicates that the wave patterns repeat at various scales, ranging from minutes or hours to years or decades. Every wave may be divided into smaller waves, which can then be divided into yet smaller waves, and so on. On an hourly chart, for example, a single impulse wave may be composed of smaller impulse and corrective waves than on a daily chart. Because of its fractal nature, Elliot wave analysis may be used by traders over a wide range of time periods, giving a deep understanding of market dynamics. 4. Wave patterns and market psychology. Elliot thought that investor sentiment, which fluctuates between optimism and pessimism, impacts market fluctuations. The market's wave patterns are created by these emotional cycles. Optimistic investors buy more, raising prices and creating upward waves of impulse patterns. Conversely, pessimistic investors sell, which lowers prices and causes waves of downward movement in a corrective pattern. Elliot Wave Theory mirrors human behavior and is also a technical instrument because of its psychological foundation. Traders can predict future shifts in market patterns by knowing the market's emotional state. 5. Practical application of Elliot Wave Theory. Finding the current wave pattern and projecting future price movements using Elliot Wave Theory are 2 steps in the trading process. Traders usually use it like this. Wave identification. Identifying whether the market is in an impulse or corrective phase is the first stage. To reveal the wave patterns, past pricing data is analyzed. Forecasting future waves. After determining the present wave, traders can forecast future waves by applying the principles of the theory. For example, a corrective wave is anticipated to occur after an impulse wave has finished. Identifying entry and exit points. Traders can choose entry points for buying or selling using the anticipated wave patterns. For example, it can be advantageous to enter the market at the start of wave 3 of an impulse wave, as this is usually the longest and strongest wave. Effective risk management. Elliot Wave Theory helps in showing possible reversal points, which helps set stop-loss levels. Elliot Wave Theory is helpful for analysis, but to maximize its impact, it must be used together with other risk management techniques and tools. With its fusion of technical analysis and market psychology, the Elliot Wave Theory gives a framework for understanding and predicting market moves. Traders can have better knowledge of market dynamics by dissecting market trends into impulse and corrective waves and realizing the fractal structure of these patterns. It is an effective weapon in a trader's toolbox, but it takes time and experience to master. Subscribe to learn more.